I was going to talk to you now about looking beyond UK for investment opportunities. Now, I've just got on the next slide, there is another quick disclaimer because there's a few things I'm going to talk about which is quite important. So, and what the disclaimer is about is basically saying that the value of investments can go down as well as up. You may get back less than you originally invested. We do not offer advice, so please understand the risks. Past performance, not a guide to future performance. I will be talking about some past performance in this presentation. You have to understand that some investments do need to be held for long term, and the forecasts aren't a reliable guide to future performance. So thank you very much for sticking through those disclaimers. They are very important, but now we can crack on. So Lisa, next slide then, please. So let's start off with the UK stock market, and I think this is for a lot of investors, this is their hunting ground. This is where they look for opportunities. They know the companies. They know they might have bought the brands or the products that these companies make. If they look at, say, the news and they're talking about the stock market, these are the names that tend to get discussed in the UK. So it's natural that people would look at this market, particularly the FTSE 100, for opportunities. Yeah, on your screen, you can see the different sector weightings there. You're getting a fairly decent spread here. There's lots of healthcare, lots of energy stocks, service companies and banks. Of course, quite a lot of these companies do business outside of the UK, so you are getting geographical diversification as well. But the issue here is that these aren't necessarily the best companies available on a stock market around the world. Quite often you're seeing quite pedestrian growth here, and of course tonight's theme is all about finding growth around the world. So I think that if you are looking for these opportunities, it's probably worth not restricting yourself just to the UK. Now, the FTSE 100 has had a very good period relative to many other markets so far this year, but on a longer term basis, it has lagged, and I'll come to those in a second. Now, if you want to invest in companies around the world, and not just restrict yourself to the UK, you'll find that investment platforms like AJ Bell, Invest, and many of the other ones make it very easy to buy companies that are listed in places like the US, in Germany or France. Now, yes, there's currency issues to take into account. You might have to pay some Forex fees, but really the whole process is not hard at all. And if you're uncomfortable buying individual shares, there's plenty of funds that invest in all different parts of the world. So actually, it's never been easier to put money into overseas markets. So on your screen, you can see a list of 10-year total returns for different markets in the world. So total return is a phrase used to describe share price gains or losses, as well as dividends. So in the US, you can see over the last 10 years, the S&P 500 index has returned 219%. So, lots of people have been talking about the US market, and I think the interest among UK investors in the US market is shot up in the last 3, 4, 5 years. And it's partly because this is where lots of growth has been found, and this is where lots of money has been made. So it's natural that people will look at this space. Interestingly, in second place in this table is the Nikkei in Japan, returned 166%. So this is, these are very strong numbers. If you think historically, you should have seen figures between 6 and 8% annual returns from equities. These are very, very sort of strong performance figures. So if you go down the list, you'll see the FTSE 100 85%. Now, that's nothing to grumble about, but actually in comparison to lots of other places in the world, it's a lot less than you've seen here. Now, on the right-hand side, you'll see the forecast earnings per share growth for some of these major markets. Now, this is the median rolling earnings per share growth rate for the next 12 months for stocks where there are estimates. And as you see, I think at the moment, this will give you an indication that if these forecasts are correct, you could potentially expect to see fairly decent returns. But I think, given what's going on with, the Ukraine war is still happening, inflation is still a major problem, and it's actually getting worse for companies and consumers, that I think that you're going to have to take earnings forecasts for the near term with a pinch of salt. Probably, I think that the risk is to the downside for some of these things. And actually, I think the same thing as well for GDP forecasts around the world. There's a chance that these could fall. But the reason I put these on here is because a lot of people ask just what's happening near term, next 12 months or even shorter. Investors are very obsessed with short periods, when I think that's wrong. You should be taking a much longer term view of everything. And yes, there's issues now, but if you're putting money away and you know, potentially if you've got time on your side, you're talking 5, 10, 15 years, just continue, do what you're doing now. I mean, you know, you're being presented with a market where share prices have pulled back, and you actually got opportunities to look at companies that are potentially cheaper than they have been for a couple of years. There might be some wobbles near term, but you might look back at this period in a few years and think, actually, you know, perhaps I wish I had the confidence to do it. So if we look at some of these markets, just to give you a flavor of what you might find if you sort of hunt around for investment opportunities outside of the UK. So on your screen, you can see the breakdown of the S&P 500 index. Here, it's full of tech. 28.1% of the whole index is technology firms. And this is where you'll find names like Apple, Microsoft, and Amazon. Healthcare and consumer discretionary also here, but really, this sort of pie chart gives you a great example of how it is different to the UK, the makeup of the FTSE 100. The UK really lacks technology stocks, and so I think this is why people are looking at this index much more and thinking, okay, this is going to be sort of a great place to look and potentially a core part of my portfolio going forward. Now, this is Germany's Dax Index, and it couldn't be any different. So look at it, it's full of chemicals firms, industrials and automotives, names like Linde, Siemens and SAP. So if you had a tracker fund tracking the S&P 500 index and one tracking the DAX, I think you could feel very comfortable. You haven't got a duplication of the types of companies. You know, these are very different makeups of stuff. So in Japan, it's really big on tech. But again, if you had a tracker fund tracking the Nikkei index in Japan, you might think, well, you know, okay, well, if I've already got a US one, I've already got big tech exposure. Why would I want Japan as well if it's so big in this sort of technology sector? I think it's because Japan has got a different kind of tech. This is sort of smart machinery and robotics and automation are very strong themes here under the tech banner. Of course, you've got consumer goods is very strong as well. And then some of the names you might know are Fast Retailing, SoftBank, and Tokyo Electron. In Hong Kong, also big in tech and big in financials. These tend to be sort of more domestic focused here. You know, the tech names might be things like Tencent and Alibaba, where a big chunk of the sort of the user base is based, you know, predominantly in China, really. In Australia, same thing. Financial services is all domestic, but the basic materials is essentially mining here. So if you had a FTSE 100 tracker and you thought, well, maybe if I look at the Australia as well, you're getting big mining exposure in both of those markets. So if you, and arguably, you know, what is there to distinguish between the types of mining companies here? They're all sort of just digging sort of big metals out of the ground, really. So it's something to think about if you're trying to put together a portfolio. Think about duplication of sectors and geographies and how different they might be. Now, if you think, okay, I don't want to look at all these individual countries, how about just one index that I could buy a tracker fund that will just give me exposure to essentially lots of places around the world? Well, one of the popular benchmarks is the Msci World, which is covering developed markets. And here, so you get exposure to about 1,500 companies from 23 different countries like the US, UK, Spain. But if you want to have more countries in perhaps in the sort of in Asia, have a look at the MSCI All Countries World Index, because that includes developed and emerging markets. So this has about 2,900 companies in it, 23 developed markets and 24 emerging markets in it. Now, you can see on the chart, the total return over the last 10 years is not that much different between them. MSCI World, which is the developed market ones, is a little bit better, 231%. But the 200 odd percent from the All Countries World is still pretty good here. And I think this, if you don't want to sort of try and guess which market is going to be in favor or not in favor, sometimes it sort of a good alternative would to be look for a blend of these markets, and this index and sort of ETFs that track it might be something that would interest you. This chart just compares some of those countries to the MSCI. So on the top, where it says A, sort of the greeny yellow color, that's the US market, the S&P 500, 339%. So done incredibly well over 10 years. And actually, the MSCI World's is a bit behind it, 231%, but still very respectable return. The DAX is returned just over 100%, and lagging it, all of them, is the FTSE 100. So we go back to the sort of the point at the start is, yes, the FTSE 100's got geographic diversification, but look how it's lagged some of those other places, so particularly that blend of geographies of the MSCI World. Now, of course, I don't know what's going to happen in the future. No one does. So I can't say for certain that these things will keep going on, and no one should ever think that just because something's done well in the past, it will continue to do so. If you were interested in tracking just this blend of the market, one example of a product would be the Spider MSCI World ETF. This trades on the London Stock Exchange under the ticker SWLD. Now, I've just talked about tracker funds. Let's go on to actively managed funds, which is perhaps going to be more of the sort of discussion tonight, particularly with the two presenters. So on your screen, you can see global funds. There are a couple of ETFs in there that cover just a couple of sectors, but this is based on the top 10-year return for global funds. So Fundsmith is at the top, very popular fund. It's 370% over 10 years, and I think it's probably one of the, if the most popular open-ended fund with investors in the UK at the moment. So other names on there: Wellington, Global Quality Growth, and there's a T Rowe Price. All of them on your screen have given better returns over 10 years than that MSCI index. Of course, when you have an actively managed fund, you're paying a fund manager to outperform the market. And clearly, the people behind these products have done an incredibly good job. If you could just take it to the next slide, you'll see the investment trust. So here you have Scottish Mortgage is 10-year return is 677%, and Lindsell Train's also done incredibly well, even better than the funds that we were just looking at. Now, not on this list is Smithson Investment Trust, because it's under the category of the smaller companies in the global world. That's the second best performing over 3 years. And of course, one of our presenters tonight is Simon Barnard, who will tell you about it. And then Smithson is part of the Fundsmith investment sort of umbrella. Part of Fundsmith is the asset management firm. Fundsmith Equity is its fund, and Smithson is the small and mid-cap product. So we'll hear from Simon in a bit, but first up, we're going to hear from Stuart Gray from Alliance Trust, who's also on this table of sort of strong 10-year performers. So that's all from me for just giving a quick sort of whistle-stop tour around the world.